Is the US dollar about to lose its crown? A seismic shift in the euro to US dollar currency pair could be the most important buy signal of the year. After weeks of intense research and analysis, I've uncovered a potential game changer that could impact your investments, from stocks to gold to Bitcoin. This isn't just another market fluctuation. It's a possible multi-year trend reversal that smart investors need to watch. Stick around as we dive into the charts, dissect recent Fed statements, and explore how this currency move might reshape your portfolio. Trust me, you won't want to miss what's coming next. Let's take a quick trip down memory lane to understand why this potential shift is so significant. For nearly 2 decades, the euro has been on a downward trend against the US dollar. Back in 2008, 1 euro could buy you almost $1.60. Fast forward to today, and it's hovering around 1.10. This prolonged dollar strength has been great for US investors with foreign holdings, boosting returns on everything from European stocks to international vacations. But here's the kicker. Long-term currency trends don't last forever. We're now seeing signs that this 15-year pattern might be ready to flip. If it does, it could have far-reaching effects on your investments and even your travel plans. So, what's causing this potential reversal? That's exactly what we'll explore next. Now, let's talk about the elephant in the room, the Federal Reserve. Jerome Powell, the Fed chair, recently dropped a bombshell at the Jackson Hole Symposium. He hinted at potential rate cuts as soon as September. This isn't just idle chatter. The market is pricing in 3 to 4 rate cuts this year alone, with more expected next year. Why does this matter? Well, when the Fed cuts rates, it typically weakens the dollar. Suddenly, the interest rate gap between the US and Europe is shrinking, making the euro more attractive. This shift in monetary policy could be the catalyst that finally breaks the dollar's long-term uptrend. But to confirm this, we need to look at the charts, and that's exactly what we're going to do next. Let's dive into the charts and see what they're telling us. Pull up a long-term euro to US dollar chart, and you'll notice something striking. We're currently knocking on the door of a major resistance level. This isn't just any old resistance, it's the upper boundary of a multi-year downtrend that's been in place since 2008. Now, here's where it gets exciting. We're seeing signs of a potential breakout. If the euro can punch through this resistance, it could signal the start of a new long-term uptrend. Remember, forex markets often move in multi-year cycles. We've had a long period of dollar strength, and now the pendulum might be ready to swing the other way. A confirmed breakout here wouldn't just be a blip. It could be the start of a euro dominance phase lasting several years. But what does this mean for your investments? Well, that's exactly what we're going to explore next. Now, let's talk about what this potential currency shift means for your stock portfolio. If you're heavily invested in US stocks or ETFs, you might want to pay close attention. For years, US investors have enjoyed a sneaky bonus from the strong dollar. When you own US stocks, a rising dollar amplifies your returns when measured in other currencies. But if the euro starts to strengthen, this trend could reverse. It doesn't mean US stocks will perform poorly, but it could take some wind out of their sails. This is especially important if you own broad market ETFs, like those tracking the S&P 500 or MSCI World. Did you know that US stocks make up a whopping 71% of the MSCI World Index? That's the highest it's ever been. So even if you think you're globally diversified, you might have more dollar exposure than you realize. Now, don't panic. Long-term investors shouldn't make drastic moves based on currency fluctuations. But it's worth considering whether you want to hedge your currency risk or perhaps increase your allocation to international stocks. Remember, in investing, forewarned is forearmed. Now, let's talk about everyone's favorite shiny metal, gold. If you're a gold bug, you might want to sit up and take notice, because a weaker dollar could be great news for gold prices. Here's why. Gold and the US dollar typically have an inverse relationship. When the dollar weakens, gold often strengthens. It's not a perfect correlation, but it's strong enough to matter. In fact, data from the past 180 days shows a clear negative correlation between gold and the dollar. So if this euro breakout happens and the dollar starts to weaken, it could act as a booster rocket for gold prices. And here's the kicker. Gold is already showing strength, even with positive real interest rates in the US. Typically, high real rates are bad for gold. So if gold is strong now, imagine what could happen if the dollar weakens too. But gold isn't the only alternative asset that could benefit from this shift. There's another digital asset that might surprise you, and that's what we're going to talk about next. Now, let's talk about Bitcoin and emerging markets, two areas that could see some unexpected benefits from a weaker dollar. First, Bitcoin. While it's not a perfect correlation, Bitcoin has often shown strength when the dollar weakens. Why? Well, some investors see Bitcoin as a hedge against dollar devaluation. If the greenback starts to lose its mojo, we could see more money flowing into Bitcoin as a potential store of value. But here's where it gets really interesting. Emerging markets. These countries often have dollar-denominated debt, which becomes easier to pay off when the dollar weakens. Plus, their exports become more competitive. Countries like Brazil, India, and South Korea could see their stock markets get a nice boost. And if you're holding emerging market ETFs, you might be in for a pleasant surprise. But remember, with potential rewards come risks. So, what should you actually do with all this information? That's exactly what we're going to cover in our final and most important section. So, what should you do with this information? First, review your portfolio's currency exposure. If you're heavily invested in US stocks, consider diversifying internationally. Look into currency-hedged ETFs to protect against dollar weakness. Don't forget about gold. It could be a strong performer in this scenario. But here's the kicker. While traditional assets are important, there's another market that could see massive shifts. Remember how we talked about Bitcoin potentially benefiting from a weaker dollar? Well, that's just the tip of the iceberg. In fact, our last video, Why Altcoins Will Soon Outperform Bitcoin, dives deep into this topic. We explored how money is flowing in the crypto market, why Bitcoin's dominance is changing, and which altcoins are poised for explosive growth. If you haven't watched it yet, you're missing out on crucial information that could multiply your returns. The crypto landscape is evolving rapidly, and what we've discussed today about currency shifts ties directly into those changes. To get the full picture and stay ahead of the curve, head over to that video next. Your financial future might just depend on understanding both of these interconnected trends.